Hello, everyone, and welcome. My name is Irina Kostko, and I am currently the president of McGill Women's Alumni Association. It is my pleasure to welcome you all to this event today. And the event is hosted by the School of Continuing Studies in collaboration with McGill Women's Alumni Association. As you know, every woman who has graduated from McGill is a member of McGill Women's Alumni Association, MWAA as we call it. MWAA began as a group of first 8 women 130 years ago. And this year we celebrate 130th anniversary of our association. And as you know, you have received all the information. We have launched a fundraising campaign in order to raise $130,000 for an endowment fund for a student, for students who will be, for girls who will be studying STEM disciplines. STEM, it's science, engineering, technology, and mathematics. And this is the scholarship for McGill students, entry scholarship. So apart from this philanthropy project this year, and where every dollar counts, of course, we organize different events throughout the year. And today, I'd like to introduce you our featured guest. Today is Christine Lengvari. Christine Lengvari is a chartered life underwriter. She is also a president and CEO of Lengvari Financial, Inc. It is a boutique life insurance brokerage firm specializing in the retirement and estate planning. Her family firm has been in business for over 65 years. The firm focuses on financial security of its clients from across Canada. Christine is trained as a chartered accountant specializing in business valuations and mergers and acquisitions. She taught financial accounting at McGill University and in South Africa. Ms. Lengvari is actively involved in the community. She chairs Concordia Alumnae Women and Leadership Program. She has been actively involved with the Montreal's chapter of the International Women's Forum. In 2013, Christine was appointed to the first advisory board of Manulife Bank and Trust. In 2014, she was named one of 50 women of influence in Canada's life insurance industry by the Insurance and Investment Journal. Christine has previously served on Concordia's board of governors and the advisory board of McGill University School of Continuing Studies. Today, Ms. Lengvari will be speaking and answering our questions about how insurance can impact your financial planning. Please welcome our expert, Ms. Christine Lengvari.
Thank you, Irina, for that kind introduction. And I'm going to start sharing my screen straight away. So hopefully you can all see my screen. And I want to welcome all the members of the School of Continuing Studies and, of course, the Women's Alumni Association members and all other friends and guests. So today I'm going to talk about the impact of insurance on any of your financial plans. And I want you to reflect, obviously today I'm looking at you and what the impact is for you. But at the same time, I want you to reflect on how this may impact not just you, but your family, your parents, your partner, your children, and the people around you that are close to you. So with that, we will go straight into the presentation. And today we're going to talk about financial goals, and then we are going to dive into insurance. So the first thing is financial goals. The most important thing in life is to decide what is important for you. People who reflect on their core values when making decisions, especially financial ones, make better decisions. So at Lengvari Financial, we always discuss core values, goals, objectives with our clients. That is always the starting point. And your financial goals will include things like saving for vacation, car purchases, and of course, the most important purchase that most of us make is our home purchase. So we are also looking at investing in the long term, which of course means retirement, and very important, protecting your loved ones. So when we have set our goals, our financial goals, then we can look at things like the insurance. What is the impact? How do I use insurance in my financial plan? So hopefully today I can show you some of how that is and may be important for you. So what are we going to look at today in terms of insurance? Well, the first thing is group insurance. And most of you will have group insurance through your employment. The other elements are the things that you can purchase individually for yourself. So disability insurance, critical illness insurance, long-term care insurance, and of course, the big one, life insurance. So when I meet with clients, the first thing I ask is, do you have home insurance? Do you have apartment insurance? Do you have car insurance? And of course, the answer is usually yes. And then I say, well, how much do you pay for it? And then people have to think, oh, I'm not sure. Oh, maybe $500, maybe $1,000. They don't really know. And yet they all purchase the home insurance, the apartment insurance, the car insurance. And they are not always sure of how much they're paying for it. So I like to take them through this exercise. And remember, this is based on a 45-year-old male during their working life. And I say, what is the probability of you claiming on your home insurance? Well, during your working life as a 45-year-old male, the probability is 1 in 2,200. But remember, they said, yes, they have protection. Do you have car insurance? Well, of course, in Quebec, we all need car insurance if we have a car. And here the probability is 1 in 1,600. So I purchase these myself for my protection. Very important, however. And of course, a lot of people are, do you want a guarantee with that phone? Yes, I'll take the guarantee. Do you want a guarantee with your car? Yes, I'll take the guarantee. But what is that? It is just insurance. So then I say life insurance. Do you have life insurance? Yes, I have it through work. What is the probability here? Well, it's 1 in 146. And I say, do you have disability insurance? Yes, again, I have it through work, 1 in 8. So you see how these aspects that affect our lives are the probabilities now coming down. Do you have insurance against cancer? Well, probably not. And what are the probabilities? Unfortunately, cancer, prevalent, indiscriminate, and during your working life, probably 1 in 3. And what about long-term care insurance? 1 in 2. Do you have coverage? So you buy personally coverage for home insurance and car insurance. You get the life insurance and disability insurance through work. But cancer, long-term care, affecting you during your lifetime, do you have coverage? And the answer is no. So again, what is available? So on death, to protect your loved ones, you have life insurance, okay? Not for you, not during your lifetime. But what is available to you during your lifetime? Disability insurance, critical illness insurance, and long-term care insurance. So first element is group insurance. Again, you have it generally through work. The main appeal, of course, is that it's inexpensive, easy to obtain, no medical questions. So I definitely encourage you must participate in the group insurance. And in most situations, you will not have a choice. If group insurance is offered through your employment, the chances are that you do not have a choice and you will have to participate in that group insurance. Now, what you need to remember, so I always ask again my clients, do you have group insurance? Yes. What's included in your plan? Well, it's health, maybe dental, because you know you can claim the physiotherapist or the massage in your health insurance. You have life insurance, you're not sure how much that coverage is. And disability, generally, you have a vague idea. You don't even know really what disability insurance is. So again, I always encourage everybody to say, what is your group insurance? Let's go through it. Let me tell you what you are covered for and what you are not covered for. But what you need to remember is that it's dependent on your employment status. You cannot take it with you. It belongs to the employer. And if you are not employed, you do not have that group insurance. You do not have that coverage. So it also expires at age 65 or when you retire, whichever is sooner. So it will cover you until age 65, and then long term, when often those medical expenses come into play, then we are not covered. There's some optional coverage available. Sometimes they have that you can increase the life insurance coverage, and you may have optional family coverage available as well. So if you have a spouse and you have children, that you can get them covered. However, the coverage is minimal. So what is covered in your group insurance? So life insurance, long-term care, long-term disability, and health and dental. And here you want to remember that if you do not have group insurance in Quebec, you must register with RAMQ, and you will have to pay for that separately through your, it's generally through your income tax, when you pay your income taxes and prepare your income tax. So what kinds of plans are available? Well, it depends on the employer, of course, and they will put it into place. And sometimes if you work for a great employer, like McGill, the plans are fully paid by the employer. Mostly small companies, PME, they have 50-50 shared plans or some percentage where the employer pays a portion and the employee pays a portion. And then some companies, small companies generally, may have an employee paid plan. So they do offer it, which is great for you, but you may have to pay for it yourself. But generally, those costs are minimal. So as part of your group insurance, you are offered life insurance and it's limited coverage, usually one-time salary. You may have an option to increase that. Coverage reduces or ends at age 65, and option to convert to a permanent plan is generally available, but it's very expensive and limited options. I do have some clients that have to do that route because of medical issues. They cannot get a standalone insurance, so they have to go through this. So as we see, group insurance is very inexpensive during our lifetime, during our working life, but once we retire, then it would be a very expensive option. So this is what I wanted to talk to you about, group insurance. I always, again, as I said, I go through this with my clients to make sure that they know and I know what they are covered for. And then we can move on to individual plans. So what are we talking about here? We're talking about living benefits. I call it benefits to you during your lifetime. So disability, critical illness, long-term care, and life insurance. So you say, well, disability, I have disability through work. Why would I want to get an individual plan? Well, we're going to look at that in a minute, but do I need life insurance? And in fact, this was one of the questions that I was asked. Well, it depends on your individual situation. But if you pay taxes, you're married, you have children, you own property, you have bills, you're saving for retirement, you want to protect your standard of living, then yes, you need insurance. So disability, what is disability insurance? It's income replacement. It is basically to replace your salary. If for any reason you are unable to work because of injury or illness, you need and want disability insurance. Now, as I say, you have it through your group insurance, but you may want a standalone policy. Why would you want a standalone policy? Well, if you're a high earner within your company, you may have, the group insurance may have a cap on the dollars that are paid out. So your full salary is not available to be replaced. So you may want to get something that bridges that gap between the cap in your group plan and the salary that you may actually get. And the salary, you've based your standard of living on that salary. So you would want to replace that. Now, disability can occur at any time. Again, it's related to your job. You may be taking a leave of absence, a sabbatical, maternity leave, or you're in between jobs, and you may not be covered. It depends on your situation. So the other element is, with regard to this, is that I often have entrepreneurs. They've been working for an employer, and they say, okay, I want to set up on my own. I'm going to start up a business on my own. Well, without a track record of salary, you may not be able to get individual and disability insurance. So good thing to set that up before you leave your employer. And of course, better definitions. If you are a specialist, if you're a surgeon, you're a dentist, you have a special skill, again, that own occupation may not be covered by your disability insurance. So the next thing is critical illness. So disability is covering your salary. It's paid on a monthly basis. Critical illness, it's a lump sum payment. And the lump sum payment is paid on the diagnosis. So if I buy $100,000 of critical illness insurance, I develop cancer, I then will be paid $100,000, and I will use that money as I see fit to go elsewhere for treatment, to get a second opinion. And available throughout is also is this what I call concierge service, business class. So it's getting access to advice either through Best Doctors or Health Service Navigator. With that's a great option with your critical illness. So we have good definitions and no spending restrictions. You take the $100,000 and you will use it as you need. So covered conditions, 98% of claims, cancer, heart attack, stroke, coronary artery disease, and then protection for a variety of Parkinson's, Lou Gehrig's, multiple sclerosis, fantastic coverage. So very, very extensive. And that's why I say this plan, the chances of you collecting during your lifetime are very, very high. So long-term care, and I talk about this, 19% of recipients are working age adults. But of course, we think of this as mostly long-term in the later years. So good for you to know that this plan exists. Something to think about for your grandparents, your parents. Is this something that they should have? And it's an extra pension for the bad time, and it's based on dependency. Do I need care? It's based on the inability to perform 2 of the 6 activities of daily living: bathing, feeding, dressing, continence, toileting, and transferring. Or cognitive impairment, what is that? Dementia. Or standby care, when you need somebody with you because you have balance issues. And here it's a pension, so it's paid like the disability on a monthly basis, and you can use it for home care, facility care, whatever you need, special equipment, changes to your home. So I move on to life insurance. What is life insurance? It's a contract between an insurance company and a policy owner. It provides a lump sum payment to a named beneficiary, and it's tax-free. It's considered to be intangible personal property and can be used as collateral. It can be an important part of estate planning, providing instant cash on death to pay final expenses, outstanding debt, etc. And for those of you in finance or investing, it provides an alternate investment vehicle for a balanced portfolio. And I would love to talk to you about that. All right, so protecting your insurability. Reality is not just anyone can buy life insurance. You have to qualify. And how do you qualify? Your health status. And the cost of insurance increases with age. So you want to protect your insurability. You may be losing out on a very important opportunity. So there's 2 types of plans. One is temporary and the other is permanent. So temporary I call renting, permanent I call owning. And temporary, we have term insurance, and it could be a 5-year term, a 10-year term, a 20-year term. And permanent policies fall into the 2 main classes: whole life and universal life. Those are the 2 expressions that you will hear. So term insurance, great thing to have, especially when you're young. You have to have more insurance. Your kids are young, and you want to make sure that you have enough insurance to cover them, until, let's say, they finish university, age 21 to 25. You want to have lots of term insurance to be able to provide for them, their schooling, their education, their needs. Generally renewable until age 80, and very important, convertible until age 65 without proof of insurability. This is so important. So if I buy term insurance and I want to do something with that because my health situation has changed, I can convert that without proof of insurability. If you get cancer, the chances of you getting new insurance are very difficult. All right, so that's term insurance. Now, I want to make a huge distinction for cost versus premiums that I pay. Regardless of what insurance you have, the cost is renewable term insurance. And it's a straight line. Every year I get older, every year it gets more expensive. However, I may not pay that yearly renewable cost, because if I buy a term 10, for example, well, then I have this staircase. So the term is guaranteed for 10 years, and then it's guaranteed for another 10 years, and then it's guaranteed for another 10 years, and then it will expire before life expectancy. So that's why the insurance company can offer this very inexpensively, because the chances of them having to pay this are very small. As my father used to say, the lottery you don't want to win, dying too young. So this is, again, premiums. It's level for 10 years. It's not the cost. The cost goes up each and every year. All right, permanent insurance. What are the benefits? It's available throughout your life. It's versatile, meets cumulative short-term needs. The children are young, then they're starting school, then they're going to university, then the grandchildren come along. It's income replacement of premature death. Complement your retirement plan. I can use this to help fund my retirement, replenish estate, or create a legacy, pay taxes on death. Gift planning. So I personally have made a planned gift to McGill, the School of Continuing Studies, and I have used my life insurance to fund that planned gift. Very exciting. And create a balanced portfolio. Again, I say it's part of your portfolio. And how can I use permanent life insurance to help with balancing my portfolio? So, level cost of insurance. Permanent insurance offers me the opportunity to pay a level amount for the rest of my life. So here I see my cost of insurance goes up each and every year. However, this is the amount that I'm paying. Now, I am paying, yes, in the early years, I'm paying way more than that cost. But what happens? The insurance company takes that money, here, this money, and uses it and invests it and uses it to pay for this, which is when the insurance costs get really expensive. And I'm happy that at the end of my life, I'm paying a level premium. So permanent insurance also has two components, the insurance component and the investment component. And is that important? Well, again, I talked about using it as part of my balanced portfolio, but that's because I do have an investment component. And why is that important and interesting? Well, in the Income Tax Act, it is permitted to put additional amounts into my insurance policy over and above the cost. Of course, there's a maximum that we're letting me put in, but I have this investment component. And why would I be interested in that, or why would you be interested in it? Well, that investment component can grow tax-free, tax-sheltered growth within my insurance. So if I have a fixed income, let's say a GIC or any other investment, I have to pay tax on that each and every year. So why would I be interested? Well, because I can grow tax-sheltered, and that portion is like your RRSP. So tax-sheltered growth, exponential growth. All right, not straight line. So wonderful opportunity within your life insurance policy. So let's look at the comparison with RRSP. Well, the big thing with RRSP is that my contributions are deductible. I am using pre-tax dollars to put into my RRSP. It's great. However, I'm using after-tax dollars in my insurance. But I have tax-sheltered growth in both. However, RRSP, once I start to take money out, which I'm required to do by age 71, everything I take out is taxable, and it's based on income. So no capital gains, no dividends, it's income. And at death, it's fully taxable. Whereas here, tax-free withdrawals, at death, tax-free. So very important aspects. Now, in RRSP, we know that the contributions we can make to RRSP are limited. Okay, so depending on my lifestyle, If I just make RRSP contributions, I may not have enough money in retirement to cover my lifestyle. So I will go to, there I have an option to use my growth portion to complement my retirement plan. So the other thing is with permanent insurance, I have tax-free access. I said it was an intangible property and can be used as collateral. So it's not a surrender. I can mortgage that life insurance policy. I can assign the policy against a loan. I can repay the interest and capital optionally. And the loan is usually 75% of that cash surrender value. That cash surrender value is my investment component. And if I build up that investment component within the life insurance, then I may borrow against that, like mortgaging your house or remortgaging your house. So great opportunity with permanent insurance. Just want to look at some of the cost comparisons. This is term 10 based on a male non-smoker. Here we have, so we see these are annual premiums. So we see that age 25, yes, term insurance, $178 per annum versus $1,269. That's a lot of money. But look what happens. Age 35, age 45, I'm still doing well. Whoa, but age 55, it starts getting expensive. And well, that's when, you know, if I'm paying this amount of money, the $14,000, it's going to start getting really expensive, and the chances are that I'm going to cancel that policy. So what usually happens is that, let's say you buy a term insurance and you go to age 35. Well, what we will do is go to the marketplace and try and buy you new insurance. But what happens if your health status is changed? Well, then the options are limited. So we see the benefit of the term, very inexpensive, and then it starts getting expensive. And yes, permanent, very expensive, but then it starts looking pretty good. So just to give you a quick overview of insurance, and now we can go to our questions. So I'm going to look at, I did receive some questions, and now I'm going to stop sharing my screen. There we go. And I'm just going to stop sharing my screen. Sorry. I wanted to stop sharing my screen, so I've stopped sharing my screen. So I have received some questions. They came in ahead of time. And all right, so there's some coming in on the chat box. We have lots of time for questions, so please submit your questions and in the chat box. But I have some questions that I'm going to start with. So does gender affect your insurance premiums? And the answer is yes. So the three factors are gender, male, female, age, and thirdly, health status. So those are the three factors that it will affect your premiums. And they're different because, for instance, excuse me, for instance, life insurance, it's more expensive for men. However, long-term care insurance is more expensive for women. Why? Because women are going to live a long time. Their life expectancy is longer than men. And so, you know, if they need care, they will probably need care for more years. So the next one. Why does your insurance premium go up? Well, it depends on what kind of plan you have. So of course, yes, we talked about home insurance, apartment insurance, car insurance. We know those premiums go up each and every year. If I don't claim, I don't get a refund. But my long-term care, critical illness, if you buy a guaranteed plan, then those premiums will not change. For instance, my life insurance, I get a T10, my term is guaranteed for 10 years, but what's also, I have information, I know what it's going to cost in 10 years. Those premiums are all guaranteed. My life insurance, I have a permanent plan, level premium, premiums are guaranteed. Critical illness, premiums guaranteed. So it depends on the type of plan that you buy. And again, as I said, your home insurance premiums go up each and every year. What should a newly undergraduate graduate know about insurance? Well, you see all the elements that we discussed today, and there's a lot of factors, and I think it's important for you to know. And do you need insurance? Well, it depends on your circumstances. I mean, if you have young children, yes, it's pretty important to have insurance. Now, of course, it depends on a lot of factors. So those are all the kinds of things that an advisor, an insurance advisor, will discuss with you. And that's why it's good to work with an advisor. You know, we go to the dentist because we need an expert to fix our teeth. Yes, you can go online, you can buy cheap insurance, but do you know what you're getting? Do you know what your guarantees are? Again, a specialist. My next question, all right, my next question is, if you are unemployed and don't have insurance, should you wait until you find employment to get insurance? Well, of course, if you're unemployed, what are your financial circumstances? Because if you can't afford to buy insurance and you can't afford to pay for it, then that's not what you should be thinking of. So yes, you want to make sure that you have a source of income in order to be able to pay premiums. What is an average amount someone should pay for insurance? Well, hopefully I've discussed that because there are so many factors. There's the age, the gender, the health status, the type of insurance, all of those come into play. People say, well, what's the cost of $100,000 for me? And I say, well, you know, I need to know your age, I need to know your gender, I need to know various factors before I can provide you with a quote. How many times should you revisit your insurance? Well, this is a good question. Well, again, at Lengvari Financial, we contact our clients on an annual basis. We send them a letter, we tell them how their policy is doing, and we make sure that there's no changes in their circumstances that could affect their insurability and their needs. And, you know, have they moved? Have they changed? Do they have children? Etc. So we communicate with our clients on a regular basis, and I think that's pretty important. So now I'm going to go to my chat box because those are all the questions I got beforehand, and I see that we have a variety of questions that have come in, so let me go to those. If one works past age 65 full-time, do insurance plans end anyway at age 65? Well, all of that depends on the plan that you have. Some plans, group insurance plans, do offer the opportunity to continue past age 65, but generally, of course, then it becomes expensive. But yes, there are plans that are available past age 65. What factors should we consider when looking for comparing insurance plans? That is, how do we evaluate different insurance plans to see which ones are good? Well, you have to look at all the fine print, unfortunately, and it's difficult and it's complicated, and I find it difficult and complicated. But again, that's why I would encourage you to work with a financial advisor, an insurance expert, who will guide you and help you in making decisions about where you should go. All right. The next question, sorry, I'm going through here. Okay, what factors should we, okay. Would there be a need for life insurance if my wife and I are both 60 years old and old, have solid savings in registered and non-registered accounts, no mortgage, and our children are independent? At this time, we only have life insurance through employment. Well, this is a good question. I mean, here you're talking about, do you want insurance? Does insurance provide anything for me after the age of 60? I hope it does. I have a lot of older clients who want insurance. Why? Well, we can talk about the charitable giving. We can talk about leaving a legacy. We can talk about grandchildren. Oh my goodness, I have so many grandparents that buy insurance for and on the lives of their grandchildren. A great gift to them and something that they can use down the line. Also guarantees their insurability. So it really depends on your circumstances. Most people think, I work with a lot of young people that are in the investment field because of my association through the Kenwood's investment portfolio program at Concordia. And they all think, oh, by the age of 45, I won't need any insurance. I'll have so much money. And then they discover, well, maybe I don't have as much as I thought I would, or maybe I can use insurance in some efficient financial way. And again, I talk about it as part of a balanced portfolio. So it would be really your circumstances to look at, and a discussion, again, with a financial advisor who can show you some of the benefits. How would you compare the investment component of a permanent life insurance to a TFSA? Well, I definitely advise everybody, do your RRSP first, do your TFSA. TFSA, excellent vehicle. All right, it's putting money in, of course, after tax dollars, and grows tax sheltered, no taxes to pay, and no taxes to pay on withdrawing the money. Fantastic vehicle. Yes, definitely you should do it. But again, we have limits in terms of how much we can put into our TFSAs. So definitely, the first is the RRSP, second is the TFSA, and then the permanent life insurance. My next question, can you talk a bit about what estate planning involves? How does it work? Well, in estate planning, again, we look at a lot of these elements that we talked about today. I say, what is the legacy you want to leave? What do you want for your loved ones after you're gone? Do you have a will? Do you have a power of attorney in case of incapacity? All of those are elements that we look at, and here at Lengvari Financial, we do the retirement planning, the estate planning, and we talk about, again, what are your values, what are your goals, what are your objectives? And that's how we help clients make decisions about what they need to look at. And insurance is a very important component. All right, now I have more questions. All right, we're doing well, and we still have some time. I'm just checking my timeline here, and we are doing well. So sorry, I'm just going to take a sip. Would there be an advantage of keeping an individual permanent guaranteed life insurance plan started early, separate from work group insurance plan? Would there be an advantage of keeping? That means that you have a plan in place, but definitely permanent insurance. Again, we saw through that previous chart, you paid more than the cost to begin with, and you know, it was a plan for life. I never encourage people to give up any kind of permanent insurance because it can be so beneficial as part of your total plan. So, and I encourage young people to get into permanent plans as soon as they can, to start thinking about the long term. What do you want for your spouse after you're gone? What do you want for your children? What do you want for your grandchildren? And what do you want for your community, such as McGill? What is the difference between an insurance advisor and an insurance broker? I would say that the terms, especially in Quebec and Canada, are used interchangeably. So I'm an insurance advisor, I'm an insurance broker, and basically it means that I have the permit and the license to sell insurance in Canada. My next question, keep them coming, we've got lots of time. What does non-participating mean? For example, a type of plan, guaranteed life term, 100, non-participating. So let me just say that the participating plan means that you get dividends like you do if you have shares of a company. So that as part of that pool of fund that is available within that plan, that you will participate in any growth and earnings of that plan. So that is what participating means. This particular term, guaranteed life term, which means that your premium is guaranteed for the rest of your life, which means, and 100 here means T100, term to 100 to age 100. And it means that you probably don't have to pay any premiums should you live past age 100. All right, next question. If you're 64 and in good health with no intentions of retiring anytime soon, what would be the best option for insurance? Well, at 64, I would definitely be looking at the life insurance. Do you have life insurance? Because that's for your loved ones. And definitely looking at long-term care insurance. At 64, critical illness, it's not an option, it's too expensive. And what comes into play at that age is long-term care insurance, regardless of whether you're retiring soon or not. So the retirement has no impact on what kind of insurance you should be looking at. And definitely not disability, because it would be too expensive. All right, we have more questions. Would there be an advantage of keeping an individual? Okay, no, I've got, those are plans. Okay, I've gone through those. Sorry, okay. If someone is having difficulty getting a new term plan due to health changes, would you advise converting existing plan to a permanent plan? And the answer is yes. Okay, definitely. So I have clients that have, thank goodness, they bought term insurance and they bought sufficient amount of term insurance. And they, you know, a cancer diagnosis, unfortunately, weight gain, cholesterol, diabetes. If you have a term insurance and you have health issues that don't affect your life expectancy, you're going to live a long time. Definitely conversion of your existing term plans. That is the solution for you. Okay, what tips do you have for young families in choosing an insurance plan? Are there any things we should consider? Young families, if you are young, your term insurance is very inexpensive, very, very expensive, both for both partners, mom and dad. Yes, both of you should have insurance term insurance, inexpensive. Buy as much as you can to provide for your children. What do you suggest for life insurance for a healthy, employed, single person in their late 20s who is not yet married with no children? Well, life insurance is if you are in good health and you have the financial resources. I mean, that's key. But if you can get permanent insurance, because you can financially afford some permanent insurance, that's what I would look at. And the other thing I would definitely look at is critical illness, because as I said, I think that's something that you will be able to claim, and it's good for the rest of your life. And if you can put a permanent critical illness insurance plan into place, that's a fabulous option. What is the maximum insurance one should have? All right, another good question. So when you're buying permanent insurance, there are financial questions. So all of the factors related to insurance is financial viability. You can't buy $100 million of insurance if you have a salary of 100,000. You probably couldn't afford it, but also you cannot, the insurance company will not sell you a significant amount of insurance. So you have to have the financial underwriting to be able to purchase maximum insurance. And so it's always a question of cost benefit. So what we do with clients is we do an insurability needs analysis based on your circumstances, your spouse, your salaries, your children, the number of children, where do you want them to go to school? We do a needs analysis, and we will, through that exercise, it's a program, through that exercise, we will be able to tell you, well, based on your factors, this is what you should be looking at in terms of life insurance, critical illness insurance, and disability insurance. So, all right, and I have another question here. Permanent insurance question, is there a minimum number of years of premium one has to pay to have beneficiaries receive the full redeemable amount? No, if you put a permanent insurance plan into place, and let's say you pass away after 6 months, your beneficiaries are paid out in full. So there's no minimum period of time. Now, once the plan is in place, you are fully covered. Last question, here we go. All right, what about insurance to maintain capital upon death, as in insurance to cover taxes on capital gains? Well, one of the factors is definitely taxes on death, and taxes on death aren't just capital gains taxes. So we need to know that there's a deemed disposition of all of our assets at time of death. Doesn't matter who I leave them to, and the only exception is the RRSP to a spouse, which will be transferred to them without paying tax. But other than that, all of my assets are valued at the time of death, and there are taxes to pay. Not just capital gains taxes, but all the taxes to pay. And yes, if you have permanent insurance, then you will be able to use that death benefit to pay those taxes, so that all of my assets remain whole and transferable to my loved ones. So on that note, thank you very much, everybody. It was a real pleasure. You had great questions, and hopefully I was able to help you a little bit with some of these important issues about insurance. And with that, I transfer it to Irina, and there she is. Hello.
Hello, Christine. Thank you very much. Thank you very much. It was a very insightful session, and I should say that the first slide completely blew my mind with the probability of the events, and the further we go, the less we have thought about. We now have the important knowledge and about various types of insurance. And we know that it actually can impact our financial planning. So thank you so much for all this knowledge. Throughout our life, we do need to learn so many things, and McGill is so helpful to organize these sessions for us. And I would really like to thank the School of Continuous Studies and Lisa Tang for organizing the event, and the team from the University Advancement, Kay Das and Irina Damulianos, for making this event happen. As we speak about finance, I want to thank everyone who has already contributed and helped us to raise the funds for MWAA 130th Anniversary Scholarship. And finally, I would also like to thank our attendees. There were a lot of questions and very interesting questions today. And I hope to see you all at our future events, starting with Homecoming at the end of September. Thank you very much. Have a good day.
Thank you, everybody.
Thank you. Bye-bye.